Hi, this is Tony Sagami again. Hey, I want to talk to you about just a general trend this week, a trend that I think is very disturbing. And what I'm talking about is that Washington, D.C.'s policies are starting to affect what's going to happen on Wall Street. If you remember a few weeks ago, I talked about how a new bill to tax the overseas income of multinational companies that was going to take a giant chunk out of corporate America's earnings. But also we now have things like the health care bill that are going to cost trillions. The estimate I saw was over $1 trillion in the next decade. So we're still on that government spending spree, but more importantly, it's starting to affect the big macro picture. Now, let me give you an example. In the 700 plus billion stimulus bill that Congress passed, that included a Buy America provision. That sounds real good to the unions and auto workers and other pro-American business interests, but it also really offended our trading partners. Brazil, for example, is even threatening to take legal action with the World Trade Organization over that Buy American proposal. And this week, what I thought was very disturbing is that in China's 586 stimulus bill, they're enforcing a Buy China policy. So now you're starting to see countries react to what we're doing, and that reaction, I think, is going to end up being very negative. If you think back to the Great Depression, one of the triggers for that was the Smoot-Hawley Tariff Act of 1930, and that triggered a trade and import and tariff war all around the globe. And so these type of things are not positive. At the same time, I want you to remember that usually in recessions, the way we get out of those is by tax cuts. That's what Reagan did, and that's what President Kennedy did. And so instead of tax cuts now, we're looking at tax increases from massive government spending. So my point is, this backdrop is pretty negative, I think, for the U.S. economy and for the U.S. stock market. As always, I think you should be selling on strength, and certainly there's been some strength for the last couple months. Use that strength to get out of the U.S. equities and reposition yourself into non-dollar denominated equities in regions of the world where the economies are growing the strongest. And of course, no place is stronger than India and China. As a matter of fact, the World Bank just yesterday updated their 2009 forecast for Chinese GDP from 6.5% to 7.2% growth. 7.2. Could you imagine what we'd be doing in the U.S. if we had that type of economic growth? So you remember, corporate earnings, stock prices follow corporate earnings, and the corporate earnings are growing fastest across the Pacific Ocean. So take this time, get out of U.S. equities as much as you can, not 100%, but overweight Asian equities and underweight the U.S. This is Tony Sagami signing off.